Wow. Back again. I was just admiring JC's Adidas jumpsuit with the All-Star Charts emblem. Emblem? That shit is hot.
Like it? I had nothing to do with the design.
It's fire, though.
Right.
All right, so first of all, you ready for what do you got going on for the summer? Anything different or?
I'm gonna go out to Portsmouth, New Hampshire, little Newport, Rhode Island. Gonna be very New England this summer. My sister got engaged. You remember Carolina? She got engaged to a Bostonite. So we'll be heading out there a few times.
Very cool, man. Excited for you. Congrats to your sister. When is the wedding?
Next spring. Year from now.
Plenty of time. The longer, the better. Like, get everybody vaxxed, right? We don't want to be walking into weddings wearing masks.
Right.
All right. Good stuff, man. Happy to hear. So it's May. We have a whole new run of charts. I was looking over what you threw in the doc this morning. I'm pretty excited to hear your take on all this stuff. So let's get into the first one.
Yeah.
Duncan, hit the charts. All right. What am I looking at here?
So what are we looking at? We're looking at historically some very aggressive year one moves in bull markets. You and I went through 2009 together. You remember that, and then you remember the frustrations in 2010.
Yes.
Take it back to the bottom after the tech bubble burst, 02, 03. Big thrust in 03. What happened in 04? Chop, chop, chop. Yep. Right? I was born in 1982. Stock market started taking off. Maybe it's a coincidence, maybe not. Right? Ripped into 83. Chop, chop, chop after that in year two. And then go back even further into the 70s. After that thrust off of 74 into 75, what happened next? Chop, chop, chop. So classic year two behavior. Listen, you're gonna have a hard time convincing me that the last year wasn't like these. So if history is any indication, year two of a bull market after that monster thrust is choppy. And what have we been seeing the last few months? Chop, chop, chop.
So 21, nobody should be surprised if 21 is a frustrating year, especially given how far we've come in the year one thrust that began, let's say, April 2020.
Best year in 75 years. I mean, what do you want?
What else do you want? I have this conversation with people all the time. I'm like, people are like, oh, how come Apple reported earnings and didn't go up? Did the stock not just double? Like what?
Like, what world do you live on? Like, what are you talking about?
What do you need, man? All right. So fast forward to 2021 is the big takeaway just really that, like, this isn't what we've been going through over the past couple of weeks. We're getting some new highs, by the way, here and there. The Dow in particular. Not many, but it's like, do you need a new high every week to justify that we're in a pretty healthy environment?
You need the components in those indexes making new highs, which is not what's happening, right? Okay. So the story, the S&P 500 is not the stock market. It's one cap-weighted index, right? Is in America. That's all it is. So you got to look at the components, not just the stocks on the New York Stock Exchange, but also the stocks on the Nasdaq and stocks around the world as well. It's a market of stocks. I know it's cliche to say that, but it's true. And it's more true than ever. So just because this is year two of a cycle doesn't mean that the market needs to be choppy. Doesn't mean anything. The market can do whatever the hell it wants. Now, is the market behaving like it's year two of a cycle? And the answer is yes.
Okay, let's go next.
So consumer staples, these are things that we're going to buy as consumers regardless of how bad the economy is. We're still going to smoke cigarettes and drink beers and brush our teeth and wash our dishes. Those are consumer staples. And historically, when stocks are doing well, those staples underperform, right? Discretionaries are probably doing well. Cyclicals are probably doing well when stocks are doing well and outperforming, and then staples tend to underperform. Now, on the flip side, when stocks are under pressure, you're going to get that defensive flight to safety relative bid in those consumer staples. So as you can see here in this chart, this black line is the consumer staples relative to the S&P 500 flipped upside down. And the reason we do that is so that you can see that it looks exactly like the S&P. So a year ago, when stocks sold off, or a little over a year ago, you could see the black line going down too, meaning staples were outperforming, which is classic behavior. And then since then, we had the best 52 weeks in 75 years. And how did staples do? They underperformed. Classic. Now, why am I saying that we're getting year two messy type behavior? Well, staples started outperforming a few months ago. That is not anything we've seen in a year. That's something new. Again, classic year two stuff.
So I think what's interesting about the staples in particular this time around, more so than any previous bear market / crash, is that we were literally hoarding consumer staples in record amounts because of the specificity of this particular crisis. In typical recessions, those stocks may do better than the market because people get defensive. In this particular recession, not only did you have that defensive bent in the market, but you also had in the real world people walking out of Costco with just pallets of shit, cleaning supplies, paper towel, So I think
we had toilet paper shortages.
Yeah. So those companies are going to have tough comps on the earnings front in 2021, unless there's some new desire to hoard the way we were last year. But I don't think people are filling their cupboards with Campbell's soup cans this summer. At least I hope not.
I mean, listen, it's less about earnings and more about money being allocated and rotating into defensive areas. And if you want to look at the next chart,
let's go.
Not only are they rotating into consumer staples, which is defensive, but the first thing that an asset needs to do before it starts going up is that it needs to stop going down, right? I think we can all agree with that, whether you're a technical analyst or not. That's just common sense. Yes. And you know what we've seen over the last couple of months? Gold stopped going down. Treasury bonds stopped going down. Japanese yen stopped going down. These were the worst assets on planet Earth over the last year. You could have bought anything other than bonds and gold and made money, right? Now as stocks have been turning, again, classic
the stuff people were selling.
The defensive assets stopped going down. And now not only did they stop going down, now they started going up.
The yen is the risk-off asset of Asia.
The yen is the risk-off asset of the currency market. Forget Asia.
Okay.
Yeah, currencies in general. If shit's hitting the fan, they're buying yen.
Okay. Gold is trash.
Trash to who? What do you mean trash?
Just trash, period. If it ever had a reason to outperform, the environment of the last 12 months would have been that reason, and it completely let people down and failed in every possible way. Maybe that changes now that it's bottoming. Maybe it starts to outperform.
I don't know if it was the right environment for it. Stocks were ripping over the last year. Why would gold do well in that environment? It should do poorly, and it did.
Well, if you think that gold is an inflation hedge and you see the money,
if you think that, you're a moron.
But hang on. But that's why most people keep gold in their portfolio as either a disaster hedge or an inflation hedge. We had a disaster. It didn't help. And arguably, we're in one of the most inflationary environments that we've seen in 15 years. And the money supplies exploded and gold didn't work. So in what environment does this commodity work? I don't know. Maybe we'll find out. But
in this environment, it's working, right? It's working. The defensive assets in general, consumer staples outperforming, utilities outperforming, REITs outperforming, bonds going up, gold going up, yen going up. All of these things are things we haven't seen in a long time, over a year.
Yeah. So some of the gold bugs would say if there was no such thing as Bitcoin, gold would be $3,000 an ounce. I don't know. Maybe.
Gold bugs aren't people I can take seriously, so I don't really care what they have to say.
Fair enough. Okay. What's next?
We're shorting the Nasdaq, right? So if you want to be short stocks, you want to be shorting the laggards, right? So we're seeing fewer new 52-week highs. Like the new 52-week high list in the Nasdaq is like, it looks like Midtown Manhattan right now. It's just a ghost town. The advanced decline line with making new highs in the S&P and the New York Stock Exchange, except in the Nasdaq, it's making lower highs, pushing down near lows. So divergences in the new high list, divergences in the advanced decline list. We're getting expansions in the new 21-day high list, which we're not getting in any other index in the world. So
21-day
lows best index for a long time. Now it's the worst one.
Hold on, expansion in new 21-day lows.
Right. Okay. What did I say?
Highs. I said highs.
Yeah, okay. Definitely
not. But this is about positioning too. This is people allocating out of what had worked last year into what's working this year. I don't think it's more complicated than that. It's not like Nasdaq 100 companies are in bad shape fundamentally or putting up bad numbers or anything like that. It's just the market anticipated great news. Great news arrived, and people are buying other shit. They're not buying this. I don't think we need to make it more than that, right?
Well, we're going to get into it in a minute, but this is part of the rotation into value and out of growth, right? Growth stocks are just, people are like, oh, I'm a growth investor. Like, what does that even mean? That just means you have recency bias. That's really all that means. Like, there's no such thing as a growth investor. Like, that worked because growth stocks were doing really well, but now it's the value stocks doing well. We've talked about it on the show. Financials breaking out of a 14-year base, crude oil, energy stocks, industrials, materials made new relative highs, chemicals. You're not just seeing it in the United States, you're seeing it around the world. Look at Europe. Look at some of these other value-oriented countries doing very well. And notice how the Nasdaq is not, because the Nasdaq is full of growth. It's full of tech. It has 0% energy, 0% financials, 0% real estate, 0% materials. The Nasdaq is not the market. The Nasdaq is a bunch of mega cap US growth, and that's the worst place to be in the world right now. So if you're going to be short anything, I like shorting the Qs, specifically if we're below 336. If QQQ is below 336, I like it aggressively short with a target of 275. And again, to reiterate, this is a tactical short. It doesn't mean the world's coming to an end. It doesn't mean we're going to have an epic crash, a do-over of last year. It doesn't mean any of those things. This is tactical. So, and then from a bigger picture investment process, if we're below 338 in the QQQ, under no circumstances can we be long. Under no circumstances. Because not only is there downside price risk, but the opportunity cost is off the charts. What else can you be doing with that money, in other words? So if you're going to be short anything, I think you short the Nasdaq, specifically if it's below 336. Or above that, all bets are off. Things are probably better than I think they are. But I have a suspicion things are about to get much worse. I think volatility is going to spike. And the easiest money and the best risk reward to take advantage of that, I think, is shorting the Qs.
Can the Qs retrace back to that 274 level of support? Yeah. And we still see that cyclical trade continue higher? Is it reasonable to say that there is a potential for that kind of environment where people are rediscovering all these, or discovering look, you have like 40 million new market participants that were just not around in 2019. For them, the Qs are the S&P 500. They're going to learn that they aren't, but that's that mentality, like that, they know Chipotle, they know Google, they know Amazon. They don't know Caterpillar. Right. They don't know Ford and GM. They don't know any industrial stock. Like, they have to learn.
Bank of America, Berkshire Hathaway. What are
they?
They
don't know these names. They don't mean anything to them.
Chemical stocks. What even is that? Right.
Right. But those stocks can now continue to be discovered by these newer investors. They continue to rotate out of the Qs. My question is, like, could we see a retracement of that magnitude for large cap tech while the rest of the market is just fine? Or is that unlikely, and it's more likely we'll see an overall correction?
I do. I think it's more likely we'll see an overall correction. The S&P 500 is actually hitting our upside objectives as we speak over the last week. So this would be a perfectly logical place for an overall market correction to take place. I think it's just that. I think it's just a correction, because getting back to the first chart of the year two, remember that on all four of those occasions, 1976, 1983, 2004 and 2010, what happened after that? Stocks went on to just absolutely rip after that. So that messy period of year two was annoying, particularly for trend followers, but they turned into springboards for much higher prices throughout in the coming years. So I think this is like that also.
Okay. Yeah, I think that seems more likely to me as well.
Yeah.
I mean, who knows? Things could change tomorrow, but that's the way that I see it too. Let's go next. What do we got? I love this chart.
So just reiterating, things changed a few months ago. Notice how we hit that peak in small caps and micro caps in February, tried to break out in March and failed. What do we know from failed moves is that we often get fast moves in the opposite direction. In this particular case, small caps went back and retested that one more time just to give everybody one last chance to get out. And now I think we continue to roll over. So I think the Nasdaq's the worst place to be in the world. I think small caps are probably the second worst place to be.
Am I allowed to say head and shoulders?
I mean, you could say whatever you want. I mean, maybe it's a head and shoulders, maybe it's not. I mean, you know me, I'm not Mr. Pattern guy.
I know that.
You know, it looks like a hot mess is what it looks like.
Yeah. All right. So I don't buy into this theory that small caps are like a risk appetite indicator for the market, or that they lead large cap. I'm not really a big fan of that kind of stuff, because sometimes it's true, sometimes it's not.
Right.
But I think what's worth saying here, last year, I have this stat, and I think it's worth mentioning. Last year, as of March 23rd this year, 95.9% of the 3,000 stocks in the Wilshire 5,000 total market index had a positive total return over the last 12 months. So from March 23rd, the bottom of the market last year, through this March 23rd, almost 100% of stocks were green. So in that environment, you know, when everything is working, that gives rise to the idea that everybody could pick stocks. Look how easy this is. But B, it's unrealistic to think that that can continue on for very much longer than a full year. It's not reasonable to think that every stock can be up over the next, rolling 12-month period, starting from April, starting from May. So I think it's just natural that we see that cool off. And that's what this chart, the IWM is the Russell 2000s. That's thousands of stocks versus like the Nasdaq 100. So I think it's perfectly natural to see stocks start to fall behind, so to speak. And that could go on for a while.
And to your point, look at the late 90s. Throughout the entire second half of the 90s, small caps underperformed. And if I recall, stocks did pretty damn well in the late 90s, no?
Yeah, small caps underperformed most of the last decade, actually. So they, coming out of the crisis, it was really a decade for large cap stocks.
Yeah.
Large cap growth in particular, but like the Russell was a whipsaw the whole time. So it's not indicative of anything.
If we're below the February highs in the Nasdaq, small caps, micro caps, you can't own it. It's that simple. You can be short, but you could be short, you could be not in it, but you definitely don't want to be in it.
Okay, what do we got next?
So this is a perfect time to think about alternative assets, right? We're talking about bonds going up, yen going up, gold going up, cryptocurrencies are going up. And this isn't like something where you're just like, for the PA account to mess around so you can tell your friends about it at the bar. These are real asset classes, folks. Look at the market caps in some of these cryptos. I mean, we're talking 50 billion, 80 billion, $1 trillion market caps. These are bigger than most companies ever, right? Some of the biggest companies in the world, these cryptos are bigger. So these are real asset classes, folks. And I was talking with a mutual friend of ours, Jim Bianco, yesterday, as a matter of fact. And he's like, listen, if investors want alpha, this is a great place to find it, because outperforming the S&P 500 is so hard, almost impossible. If you want real alpha, you got to look at these alternatives. And in a year two, classic year two, these are great alternatives. So I can show you a million different crypto charts. I mean, we've been doing really well with them, obviously. But this is the one that really has my attention, and it's Ethereum relative to Bitcoin. You know me, the bigger the base, the higher in space. And that's a big bottom, baby. Yeah.
Ethereum's got a lot of different properties relative, not that we want to do a whole crypto spiel, but there is not a cap on Ethereum the way that there is on Bitcoin. So the value of ETH to me is more about usage. The value of Bitcoin to me is more about scarcity and thinking about it like a digital gold or gold 2.0.
So
Ethereum is not that. Ethereum is about like how many people are building apps on top of it, or how many people are building, things that you can actually use versus things that you're just going to tuck away and store. And so the other chart, I don't think you made this chart, but another chart that's interesting to watch is transactions in Ethereum. Because if this is really going to be a thing, then you should see the transactions grow along with the market cap. Maybe we'll do that next month.
And they have been, right? You're getting a zillion more transactions in Ether, but in terms of dollar amount of transactions, Bitcoin's still winning.
Oh yeah, I mean it's
at the higher
it's
price,
so,
right?
it's so much bigger and it's a higher price. I think
By
it's
the way,
interesting.
Bianco, not to keep mentioning Bianco, but I had a great conversation with him. He's the man. He thinks Ethereum is priced higher than Bitcoin.
Really,
That's where we're going.
Like eventually, Ethereum's
It's hard for me to disagree.
3,400 right now.
I mean, listen, Bitcoin can come down just like Ethereum can catch up, right? It might be a combination of the two, right? They might meet at 100,000, they might meet at 30,000, who knows, right? But I'll tell you this much, I don't know about all that. I don't know about the fundamentals. I'm not, I stay in my own lane. I see a big base, baby, and I've seen what these big bases do after they complete, and this looks like it's completing.
I wrote about the taper tantrum on my blog this morning from 2013. I think we're going to have another one this summer or fall. I'm just telling you, I don't know what level these cryptocurrencies will be at before that starts. They could all be 1,000% higher, but they're going to get destroyed. Not permanently, but because one of the things that's going to happen during the taper tantrum 2.0 is the dollar, if it's falling at that, it's going to stop falling in its tracks and spike. And I think emerging market currencies will get killed. Like we'll do that whole thing. It may last for an hour or it may last for a month. I don't know. But I think it's pretty likely that that's going to be, if you missed out on all these cryptocurrencies, maybe that'll be your buying opportunity.
And you make a good point. And I don't think anybody's really going to disagree with you. I think you're right. I think a lot of people will agree with that. The question, right, is do we get that 60, 80% correction in the cryptos starting at Bitcoin 70,000, at Bitcoin 250,000, right? Like where does that start? I think we can all agree it will happen eventually, but from what price?
Exactly. I don't think it's something that you can that you can even make an educated guess at, because during the last taper tantrum, Bitcoin was probably $20, $50 a coin, and nobody was paying attention to it. It certainly wasn't being treated as a macro asset by hedge funds, I'll tell you that. So there's no record of this. We're just guessing. But
we're making it up as we go along.
100%. But if we think it's an alternative to the dollar and it's being thought of that way, traded that way, used that way, unfortunately, when Powell makes the offhanded remark to Congress that they're thinking about adjusting, blah, 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 asset. Look, we're buying $80 billion in treasuries a month right now and another $40 billion in mortgages, and there's absolutely no reason for it.
I'll tell you something. I think at the very least, I don't care if you're a financial advisor, a young trader, an old school investor, whoever you are, and Patrick Donawillo of the Chart Report, I think, said it best. The risk in crypto, the risk in Ethereum, NFTs, the risk you have is to ignore it. At the very least, put a couple $100 in a wallet, go through the process, actually do it with money you don't care about, just to understand. Because, and I agree wholeheartedly, the biggest risk is to ignore it and thinking it's going away, and I don't think it is.
Okay, we got a couple more. Let's jump in. What's next?
So this is the growth value, right? This is the big story. This peaked. This started last September, so it's not anything new. There's a reason why growth stocks are getting killed, not just on an absolute basis, but particularly relative. You talked about how like new investors don't know how to invest in banks and energy and chemicals and whatnot. They don't, but the rest of the world does, and you're seeing that happen. Money coming out of growth, going into value, and not just in the United States. You really see it overseas, JB. We talked about Europe last month. I mean, we've been talking about Europe a lot. It's been doing well. It's a completely, they have much less tech exposure, a lot more financials and industrials and things like that. And then if you want the cheat code of what the growth versus value ratio looks like, just look at tech versus financials. It's going to look the same.
Yeah, I actually think like everything that drives international markets is sector related. Yep. Like when industrials are doing well, German stocks do well. When financials are doing well, you will see that reflected in European stock markets. And when tech is outperforming, there's just no possible way Europe is a better market than the United States. It just can't be. Right. So I think like it's really more about sector preference among investors and positioning, to your point, who's buying what, who's selling what, versus like, ooh, I'm bullish on France. Nobody invests that way. Okay.
You want to know something interesting? I'll leave you with one thing, and I wish I had the chart. If if you take the CRB index and rather than having it like it is, if you equally weight all of the commodities, right, and turn it into an equally weighted chart, and you overlay the all country world index ex US, so in other words, the rest of the world, both charts look exactly the same. Literally.
I would love send me that. I'd love to see it.
I will.
What's next?
All right, so I want to leave with a trade, right? Everyone's like, all right, JC, great. What's the damn trade? So this week we dropped the Under the Hood report. These are stocks that are showing an unusual increase in investor interest, whether it's high volume coming in, insider buying, spike in social media mentions, unusual options. For whatever reason, a bunch of lunatics are paying more attention to these stocks than they were before. That's all the list is. And that's this week's list. And then we hand select the best risk rewards on both the long side and the short side. Because sometimes the lunatics are right and we want to jump on the momentum train. And sometimes it's like, well, these people are nuts. Feed the ducks and take the other side.
Okay. Pause for 1 second. How many names are on this list?
There's usually 40 to 60 names.
Oh, this is 60.
There's no magic in the amount of number.
Okay. I see you got one. I'm looking for bulk. I'm looking for dry bulk shippers on here. I see you got SB.
They're there.
Okay. The one I've been watching is Star Bulk, SBLK. I missed a lot of the run, but I feel like there could be. It's one of the biggest bases you will ever encounter.
Listen, for SB,
look at the base in it.
That's the level. $4 on the SB. If it's not above $4, you can't own it. But if you're, I've gotten asked more about the dry bulk, Baltic Dry Ship Index in the last week than I have in the last 10 years combined.
Exactly.
Funny thing how price changes sentiment, huh?
Okay. All right. So what's the name from this list that you picked out this week?
Yeah. So I like energy. You know, sticking with that value theme. This is, you know, incorporating our top-down approach, our global macro views, and now we're looking at the bottoms-up approach. And hence selecting something that makes sense with our macro views. Listen, we like value. What's wrong with Kinder Morgan, KMI? We talked about the monster base in Ether versus Bitcoin. Look at the monster base here, same idea. Bigger the base, higher in the space. The risk versus reward is very well defined because we only want to be long Kinder Morgan, KMI.
All right, hold on. We got to get the chart up. Duncan, did you fall asleep?
Throw it up, Duncan. Kinder Morgan, KMI.
And I thought we were supposed to have a sound effect when we posted a chart. Don't we have like a drum or an air horn or something? All right, we'll have to fix that next time. All right, KMI. This is like a blue chip. It was formerly one of these like what's it called? Master limited partnerships, and then I think they changed over to corporation. So now it's in a whole bunch of indexes, but it's the same thing. It's like energy assets as opposed to like drilling for oil. It's like the pass through, the transfer of energy.
Midstream is what they call it.
Midstream. Okay. So
Fancy,
what's going on here? Super fancy.
Look at that breakaway gap to the downside a year ago when it really broke down. Then the market bounced back last summer, kissed that level, continued to consolidate. Now we're back to the scene of the crime. Maybe this is the breakout. Maybe it's not. We have all the time in the world. Be patient. If we're below 17.5, you cannot own it. You can't own it below 17.5. Above 17.5, however, I like it very long, 35% of upside.
Is this so we expect that this could fill that breakaway gap above 1750, which takes it where? 19?
22.5, back to the former highs from last year.
Oh, all the way up to the top. Okay. So when do you know you're wrong? Like I would assume it fills the breakaway gap and then there could be a retest. Like when do you know that, oh, forget it, this is a false breakout? Like, how do you manage that?
17.5 below that, right, you can't own it. Below overhead supply at those levels. We have to be above 17.5 to be long. Otherwise, leave it alone.
Would you get long this and trail it with a stop, or just use your eyes?
I hate trailing stops. Trailing stops, you're begging for the market to go kiss your stop and then rip. Trailing stop makes no sense whatsoever. Set the plan. We want to be long if we're above 17.5. Let's say you're one of these take half off the table people. Then, I don't know, maybe 2021 is probably a good level, but have that plan prior to, right? Versus an arbitrary 5% trailing stop. Those things are terrible.
You know what's so funny? Like most of the people in this stock in KMI are not there for the technicals. It's a 6.8% dividend yield. or distribution, whatever. But like that's the bulk of the assets that are in this stock right now are ETFs, like dividend ETFs and institutions that are in it for the yield. But getting a technical breakout to the upside is like a cherry on top. And if you're not buying it to stick around for that yield and you're just buying it for the trade, the yield could be 1%, it could be 10%, who cares? You're not collecting it. So it's like two different ways to think about the same ticker.
Yeah, for me, I think that the yield is the cherry on the top, and the technical breakout is
right. No, I know.
my attention, obviously, but sure.
That's awesome. All right, so where can people get that list of what do you call that list again?
Under the hood.
Under the hood. So how do people find that on your site, and how can they learn how you construct it?
Yeah, email candles@allstarcharts.com. That's candles@allstarcharts.com. And what we're going to do is we're going to send you our latest Under the Hood report and a video we just put together this week to give you a good idea as to what's really going on behind the scenes, how we approach the market from both a top-down perspective and a bottoms-up to supplement all that work. It's good times.
That's killer. You're coming into Manhattan at all this May? We're going to hang?
You tell me. What's the plan?
All right. I might be there next Thursday. We'll talk.
All right, let me know.
Hey, absolutely. Hey, guys, make sure you check out JC's site, allstarcharts.com. He's loaded with great stuff. I read all his commentary. I learned so much from the email blasts, everything he puts out. And we'll see you next month. We'll be back early June for the next set of charts, and we appreciate you guys tuning in. Thanks so much.
Thanks, JB.